Let's see some highlights of the budget presented for the fiscal year 2020 to 2021. Union Budget 2020-2021 was announced in the backdrop of a tough economic environment with high expectations to revive the economy by stimulating investment and boosting consumption. However, it fell short of prevailing high expectations as the government continued to prefer fiscal consolidation and held growth recovery at bay. The government has continued to focus on infrastructure, agriculture and rural economy, social welfare, simplification of taxes, and leveraging technology for better governance. Fiscal prudence was maintained by refraining from increasing borrowing limits for fiscal year 2020 and marginally higher borrowings during fiscal year 2021. The continuity would be thrust on the farm and agri-infrastructure segments. The government announced various schemes like increased insurance farm coverage, ensuring faster movement of perishable goods by proposing PPP model under Kisan Rail, etc. Remain committed to doubling farm income by 2022. We believe a strong focus on agriculture, irrigation, and rural consumption bodes well in the long run. The government's trust in infrastructure sector also continued. In December, the government had launched Rs 102 worth of infrastructure projects under the National Infrastructure Pipeline to develop social and economic infrastructure in the next 5 years. As we need to find some sustainable ways of funding infrastructure in the country, 100% tax exemption to sovereign wealth funds for investments in infrastructure. The next is the fiscal consolidation path that got maintained. The government has adopted a limited fiscal slippage against the demands for a big stimulus in order to balance growth concerns without affecting the market and debt obligations. The budget pegged the fiscal deficit to GDP ratio at 3.5% for fiscal year 2021 and 3.8% for fiscal year 2020, in line with the street expectations. Gross market borrowing for the next year at Rs 7.81 trillion is in line with the market expectations, while no extra borrowing for the current year is a big positive surprise for the market. Let's also see how the changes in taxation are likely to impact us. FM has introduced an optional simplified tax structure based on income tiers with lower rates for individuals but without any tax exemptions. It may sound foolish at the outset, but it has the potential to boost consumption as many people skip consumption just for investing to save taxes. Companies have been exempted from paying dividend distribution tax, while dividends will be taxed in the hands of the investors at marginal tax rates. With the abolishment of DDT, dividends on equity mutual funds will be taxed at the slab rate of an individual taxpayer. Now, investors looking for regular income from their equity investments should look at systematic withdrawal plans from a tax efficiency perspective. Let's also look at equity market outlook. Although the budget did not deliver on the key market asks for equity markets like relaxing LTCG or removing STT or big growth stimulus, we continue to remain constructive on equities and recommend accumulating equities in a staggered manner through SIP or STP. Nifty 50 forward PE ratio stands at 17.5 times, which is near 10-year average, and hence would provide some support after a round of recent correction. We are still positive on small cap, mid cap post recent underperformance since January 2018 and reasonable valuations. Multi-cap space can be looked at from a long-term perspective. Let's also have a check on debt market outlook. The debt market is likely to react positively on the back of fiscal discipline. the deepening of the bond market by increasing the FPI limit from 9% to 15%, along with the complete opening of certain specified categories of government securities for non-resident investors, may also lift sentiments in corporate bond space with improved market efficiency and rate transmission. A muted late-cycle global growth dynamic may be further impacted by the coronavirus outbreak. If the central banks take into account this new growth headwind, it may increase local market risk appetite for bonds. We continue to remain highly positive on accrual space, spread assets, and should be the main theme for 2020. Thank you so much again for tuning in to Dream Letter Capital. If you like the video, please like, share, and subscribe. And yes, please do not forget to comment on what your take is and what would you like to hear next from us. Until then, take care.